Equities grind higher ahead of mega cap tech earnings. The dollar clings on to vital support as copper and grains explode to the upside. All this and more in this week's Macro Insight. Okay, so welcome back to Macro Insight. Particularly welcome to the new subscribers and trialers. Today is the 27th of April, and let's take a look at markets. So we've just been getting more strong economic data coming through. Last week, you had European PMIs, upside surprises. The vaccine momentum has picked up massively in Europe. About first doses of vaccines have gone out to about 25% of the population. So definitely accelerated the pace there. You also had really strong data continuing to come out of the US, like US manufacturing ISMs, highest since 1983. And stocks have continued to grind higher, but certainly losing momentum, right? So let me share this chart. If we bring up the S&P chart, you can see we've kind of ground out a new high, very, very close to 4,200, which is quite a big level in terms of targets, but the momentum indicators are really struggling, right? So that's the thing, like I mentioned last week, that we are making highs, but the rate at which we're making them is slowing down, which leaves us susceptible to a potential pullback, right? Now, we did see a brief sell-off end of last week when we heard about the capital gains tax. But that was very, very quickly brought back because people thought it would be watered down. So what we had, the headline was that Biden's proposing raising capital gains tax on the wealthy to double what it is now, pretty much, to go from 20% to 40% and be more in line with income tax, basically. But then, market kind of got a bit panicked on that initially, but didn't take long to recover as, the market started to price in that it's going to be hard to get that through Congress, certainly in the form that he's saying. So whilst there may well be tax hikes, maybe it won't be quite as dramatic as that. And so, another reason why the market comes off is because it might trigger some profit taking in stocks while the rates are relatively lower. And before those changes come in, people can have the lower rate of tax. But the truth is, where's your alternative really to park your cash, right? So anything you park it in that you're trying to get a capital gains on, you're still going to have to pay the capital gains tax that's higher, right? And right now, stocks seem to be one of the main games in town, given the backdrop of liquidity and given loosest conditions we've ever seen, right? So that's kind of really why the market didn't really get that phased by it. So we've been seeing now, whilst we've been seeing sentiment indicators also quite extreme bullish, and that was another thing that I mentioned last week. An interesting sort of chart that I saw this week was from Deutsche. So that chart there shows you discretionary versus systematic equity positioning. And basically, whereas we've been saying, extreme bullish sentiment and positioning from discretionary fund managers on the back of, a very positive backdrop, certainly for the summer, the systematic strategies and the CTAs are not so bullishly positioned yet. So there's definitely room, if you look at it from a percentile basis, they're at like 46 percentile versus discretionary guys at 99, if you look back the last 10 years. So arguably, the trend followers and the CTAs have still got a lot of room to increase length in equities, right? So you might find that as the summer kind of continues and that momentum stays in markets, or that bullish sort of trend stays in markets, then these CTAs start to up that positioning, and we have actually still got fuel for a bit more upside. So I thought that was quite interesting from Deutsche. And then another thing to factor in is stock buybacks. So, stock buybacks have been pretty much one of the major culprits of the rally, say from 2017, 18, right? And the idea was, market rates were being suppressed by the Fed, and companies would borrow money from capital markets and they'd buy back their shares, and they're buying them back in record amounts in 2018, right? Now, apparently, there's even more authorizations to do stock buybacks this year. And so this could be an even bigger year than 2018 for stock buybacks. And whilst earnings season comes to a close, sort of over the next couple of weeks, as the blackout periods and the windows where they're not allowed to buy back stock, as those windows expire, then that could bring another healthy bid into this market that will at the very least be supportive and may continue to drive equities higher, right? So you are hearing a lot of, people saying why we're a bit overstretched. And whilst I kind of agree, there are signs of that, the other side of that coin is this kind of buybacks and this other issue, yeah? Okay, so that's kind of what I've been thinking about sort of US equities. Now, you have got more treasury auctions this week. You've got to keep an eye on the 10-year to see, if has found a short-term bottom. Despite the recent strength in US bonds, which has likely been led by a positioning squeeze and foreign demand due to those sort of relative yield differentials that we've got out in Europe and Japan. I think as the rest of the world starts to deliver stronger macro data and global yields as a whole start to rise, then you would think the US yields are going to kind of go up with it, basically, right? So that's the idea. And if you look at the chart in the US 10-year, it does seem to be stabilizing and look like it might be finding a bit of a bottom in the short term. Yeah. So I had some retracement levels marked out at 152 and 158, and it is kind of found a decent sort of range in there and managed to find some support and stability. Okay, so that's kind of treasuries. You have got FOMC this week, unlikely to really give you any clues on the taper timeline. Bloomberg did do a survey with top economists, and the kind of general feeling, like most economists came up with a Q4 this year for them to start to slow bond purchases. So that was kind of where we're looking at the moment in terms of market expectations, but even though that's not necessarily what the rates market's pricing in, but then Bank of Canada, surprisingly, they already signaled the end of their monetary policy support last week, and you saw a bit of a move in the currency on the back of that, right? So will the other central banks follow suit quite as quickly as Canada? Remains to be seen. I mean, anytime the Fed gets an opportunity to speak, they seem to be, still pretty dovish and saying that, that they're going to take it as slow as they can, right? So now, while the inflation fears seem to have dissipated somewhat from bond markets, and the recent bond market move showing us that, Bank of America did put out a report indicating that data on inflation and some leading indicators are kind of heating up a bit. So you've got, let me just bring up, well, basically, I'll just mention it. It's in the report, right? But, the mentions of inflation on the earnings calls have tripled so far, basically, right? So, and that usually has a lead of about a quarter on actual inflation, on actual CPI. So the idea is if on all the earnings calls, all these companies are fearing and worrying about inflation and mentioning it, often that tends to lead, and we tend to see inflation actually come through, right? So we're starting to see that. Also, looking at some of these Fed manufacturing surveys, prices paid indices are kind of going through the roof as well, right? So you are starting to see that inflation. Obviously, the big debate has been, is that inflation going to be persistent or not? Remains to be seen, but more and more people are coming out thinking, yeah, it will likely overshoot and it will be there longer than you think. And partly because labor shortages, right? So the labor shortages are becoming a problem for companies because people are being given money from the government in the form of stimulus to sit at home and not work. So it's making it harder for people to hire. and that's going to bring pricing pressure, and people be forced to offer higher wages to get these people off their sofas and working, basically, right? So those are kind of the dynamics at play there. Okay, so that's kind of on the macro front. Now, all eyes on earnings this week, especially big tech. You had Tesla last night. They did beat on profit, but revenue guidance was kind of disappointing, as some of their earnings came from environmental credits that they were selling, and also Bitcoin trading. They locked in like 100 million on Bitcoin trading, right? I think their mark to market was more than that, but in terms of what they traded out of, they made about 100 million, right? So the stock's looking down about 3% pre-market. Now, I have been saying that I think these large cap techs, despite having good earnings growth, are going to struggle to rally immediately post earnings, right? There's quite a lot baked in there in terms of expectations, comparisons from last year, because the demand was pulled forward for a lot of these tech companies, right? The digitization of the economy, all that stuff. And if you look at Netflix earnings, it's clearly evident, right? Netflix got massive influx of subscribers, and it's massively tailed off, and their expectations of next quarter are pretty dire, right? So, these are now, Netflix is particularly going to be affected by that sort of thing, because it very much is a stay-at-home type play. But I think tech in general would have benefited from a bit of that move to digital. And so as we are reopening and we're going to start to see some normalization of that, most likely, right? And that's what makes me think that the Russell versus NASDAQ spread that I've been flagging is potentially an opportunity here to do a trade, because, like I said, it had pulled back about 11-12% from its high, even though the overall markets hadn't really moved and they were still at all their highs. So I think there's room for this to rally. We've made a bit of a double bottom here in that confluence zone, which I'd marked out, and we've got room, right? We've got a good 10% potential to get back to those highs, and if we do start to gather momentum on the reopening, the leadership's more likely to come from the value and the cyclicals and the mid caps, I think, than it is from big tech, right? So I have entered into this trade as a spread trade in futures. I also think using optionality isn't too bad here. I think, you could buy Russell calls, for example, to June or July, and you can sell NASDAQ calls or NASDAQ call spreads if you wanted to play it a bit safer as a way to get some of that premium back, basically, right now. So then if we don't really rally or go lower, you haven't really got an issue. And if we rally, provided the leadership is coming more out of that sort of mid-cap space and that cyclical space, then that's where your trade kicks in, and you could do quite well if we get an outperformance of, say, 5 to 10% over the next couple of months in that spread. Yeah. And then what else? So the VIX has been chopping around in the kind of 17 to 20 range. Realized still remains pretty low in the kind of 10, 11 area, right? So, I mean, I do think there's room for VIX to head towards 15 again, and kind of settle in that sort of 14 to 18 range over the summer. Because, like I said, the premium to realized is still pretty juicy. And realized could well go into single digits as we head into summer, right? So don't rule that out. Cross asset vols also falling across the spectrum, whether it's FX, rates, commodities, even like if you look at implied vols in copper, even though copper's breaking out, the implied vols have come off quite a bit. So that's the kind of thing. And so, you've got cross asset vol falling, you've got people feeling optimistic about recovery, central banks holding the line, and macro data taking out records. Yeah. So you have got a lot of stars aligned for a potentially low realized up grind over the summer, basically. Yeah. In EM, you've got India recovering nicely in terms of the market, not so great in terms of what's going on with COVID. If I bring up the India chart here. So, I've been scooping this. I have been long this. I was saying I had other levels where I'd pick up some more from a long-term play. Didn't really get to my level, unfortunately. So I didn't manage to get any more, but I didn't get shaken out, right? I'm still in the trade there. Obviously, a bit of carnage in terms of what's been going on in COVID in India, but the US has offered them some vaccine support. that's kind of helped the recovery a little bit in stocks. And like we said, some of the mobility data showing, and some of the kind of rates of change on the states that got the worst cases early, we're starting to kind of peak, right? So I think that's kind of the market's trying to look through it, basically, and trying to look through the current carnage, as it tends to do. Yeah. Think about how when we bottomed out last sort of March, right? I mean, we were still going in to the eye of the storm in terms of COVID, but the markets kind of price it out quicker. Yeah. European equities, right? So you've got they're slightly off their highs, so not quite doing what the US is doing in terms of making new highs every day. So they've had a bit of a pullback, but the DAX had got very, very overbought. So RSI had got up to about 80. DAX kind of needed a bit of a consolidation period. It's kind of had that. So, you know, arguably DAX not as overbought as it was. And then, you know, with the acceleration in growth likely to come, albeit a bit delayed in Europe, you know, Europe arguably is still offering you the better value in terms of equity markets, right? I mean, it's generally a bit more unloved. You know, so is there a rotation out of US into Europe coming? So if you think about growth, if growth is gonna, you know, peak in the US in Q2, is likely to peak in Europe in Q3 or 4, then, you know, that might be where the trade is, right? Where people rotate into where we get the acceleration in growth, right? So if you sympathize with that view, and it's always a dangerous view getting too bullish on Europe, especially Europe versus US, but if you do sympathize with that view, then looking at where the implied vols are in Europe, for example, July upside calls are in the kind of low to mid teens. You know, so for example, something like the DAX 16,000 calls, that may offer you some half decent leverage to that view that Europe's going to have a period of outperformance as those vaccine rates start to really accelerate and we get a proper reopening out of Europe, right? So something to think about. You know, we had talked about maybe doing that trade in the UK as well for the FTSE. That trade's still arguably there. The vols are cheaper on the FTSE as they tend to be. So maybe even FTSE calls could work as well as a bit of a reopening play, right? So maybe, or a bit of both, right? So something to think about. Okay, so coming up this week, like I said, macro taking a backseat as earnings are in the spotlight. You've got mega cap tech, kind of the main event. That's likely gonna determine the fate of the S&P and the Nasdaq this week. So what we got today, Google and Microsoft. Wednesday we do have the FOMC meeting, like I said, but it's not really going to matter too much. Apple, Facebook, and Boeing, the big ones to watch on Wednesday. Thursday you've got some US GDP Q1 numbers and Amazon's earnings, and then on Friday probably the biggest one to note is Exxon. Yeah, so those are kind of the things to look out for on the calendar this week. If we then move over to FX, the dollar. Bring up the chart on the dollar. So yeah, I mean, I said last week, dollar trend is at risk. So it's still at risk, right? So we've been kind of stuck to this, just under this sort of level here, around 90.8. Not more 91, but you know, we kind of pushed just below it, but not a conclusive break, I wouldn't say just yet. You know, with the prospect of some growth coming out of Europe and lower US yields that we've been seeing, the dollar is under pressure. If you, like I say, if we get that sort of cycle where US growth peaks early, then we're going to get more out of Europe, and then maybe Asia is even more delayed with what's been going on in India and Japan. Then there may well be more dollar weakness in coming months as the market starts to move away from what has been the outperformer into those other places where there's more value, right? A conclusive breakdown of 90.5 in the DXY will take us below here. Then you have to admit that level's gone, and likely going to bring some more sellers, right? There's a lot of bearishness on the dollar at the start of the year, and those sellers are arguably waiting to pounce on the dollar again, right? That's the kind of feeling I get. Most macro strategists are long-term bearish on the dollar, but tactically some were prepared for a bounce and so went a bit more neutral. But if the price action starts to confirm that bear move in the dollar, I don't think it'll take long for them to all to jump on it. Yeah. The flip side, obviously, if those US yields do manage to spike again and in the absence of any other yields spiking alongside them, then you will probably get a more meaningful bounce out of this dollar. But for me, I'm starting to favor maybe selling bounces in the dollar, right? Given the price action, given what it's done, I'm wondering whether that's the sort of way to start leaning, basically. Yeah. And that brings us nicely onto commodities. Yeah. So commodities, let's talk about the exciting stuff first, right? So copper's been on a tear. I mean, that chart's kind of gone a bit parabolic. That consolidation was you had a really big impulse move from sort of February up to end of February. You had a nice textbook consolidation. We held on to some key sort of support levels in terms of moving averages. And then we've resumed the uptrend, right? I'd said Goldman's had put out a piece kind of talking about the decarbonization and the kind of move to green and electrification, etc. That demand story was just going to be too strong to ignore, right? So, and then interestingly, again, Deutsche put out some data on kind of positioning, showing that the sort of net long contracts in copper are nowhere near the highs, right? So it looks like, I think just that move being so explosive back in February probably took a lot of people to think that it was overdone. They've kind of lightened up and now they're missing the rally, right? So, and generally, FOMOs could well be kicking in and those people might be forced back into the market, right? So something to watch out for, but positioning doesn't seem that heavy in copper, even though the price action is exploding. So, we may well have fuel to get up to even $5 on this one, which currently sitting at about 4.5, 4.45. Yeah. And then you've also got grains, right? Grains on absolute fire. What you've got kind of 8-year highs in the agricultural commodities. So that's the Bloomberg Agriculture Spot Index. So you can see absolutely flying. And if you look at some of the month-to-date numbers, you've got corn and wheat up 25% each, right? On a year-on-year basis, they're up something crazy like 70, 80%. Yeah. So what are the reasons that are kind of this is being put down to a few things, especially the recent spike. You've got a drought in Brazil. So a lot of the commodities sort of coming out of there. You've got cold US weather affecting the planting season in the US, sort of delaying that. And you've got strong Chinese demand, basically, right? So those have kind of been the main factors that have given fuel to some of this explosive price action in this sector. Yeah. I've been long them. I've been long them just in terms of the general commodities theme, right? Getting into the commodity trend on dips. The only thing that really gave you a dip was wheat. You didn't really get any meaningful dips in things like corn and soy. I got into that wheat on the dip. I took some profit actually last week as we reached what looked to be a bit of a resistance level, but knowing how likely it was that level could just break and it fly to the upside, I only took part of my position off, and I'm kind of trying to run this trend as long as I can, but just kind of trail my stop as we go along, right? And that tends to be a good way to participate in things that are trending so strongly. Yeah. And then, so that's, ags and copper, that's where the action has been. And then you've got the likes of gold and oil, which quite frankly have been quite boring, right? We bring up, where are we? So oil kind of rangy there. You can see not doing too much. Now, obviously it's kind of benefiting from the general commodity story and the weaker dollar, but then the flip side on oil has been fear regarding Indian demand weakness, because they are the third biggest fuel consumer in the world. So that's kind of been, maybe pulling it back a little bit. You've got the OPEC meeting this week, I think tomorrow, I believe, or Thursday, but usually you expect OPEC to kind of support the price, right? So no major changes expected out there. Yeah. In terms of gold, this week's been pretty quiet for gold. Gold obviously had its break above 1760, and as I said, it went into no man's land. and it's not done a lot, right? So it's kind of confirmed we are in no man's land. It's not really got any clear direction on gold. I think there's quite an important level up around 1825, maybe a little bit lower, sort of somewhere 1815 to 1825. If we kind of eke our way up there on no great momentum and yields haven't broken below sort of 140, then I might look at buying some more puts to play that sort of trend, the idea that gold will ultimately top out and follow yields back up, and gold will kind of come back down, right? Assuming real yields will rally, right? That's kind of that's what I'll be going for if that's the sort of price action that I see in gold. Yeah. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. I'd also encourage you to sign up for a free trial to our live and interactive Macro Insight Zoom call. As part of our trading community, as well as the call, you'll also get access to our Telegram chat and our weekly market reports. To find out more, you can also connect with us on the socials. All the links are at our website, www.options-insight.com. Thanks.